It's been a tough year for oil traders. Prices have been slipping, the curve isn't behaving the way you'd expect, and geopolitics keeps everyone on edge. As we head into 2026 with a lot of mixed signals, we're taking a look at what shaped the year and what traders should be watching next. I'm Johanna Bota, and joining me today is Marco Saggese, VP of Clearing and Execution Sales at StoneX. Welcome, Marco.
Thank you.
Happy holidays, Happy New Year. This is our last show together for the year. So let's start with a mini recap of 2025 as a whole. Like I said, it's been a challenging year for oil traders. How would you sum up the year we've just had?
Well, it's been really an interesting year, but as I mentioned, it's been a really tough year for the traders to get a hold of any sort of margin that's out there. We had several things happen. Obviously, in January with a new president coming in, and the famous word tariffs came in, and that caused a few issues. But as the year went on, that word moved away, and we've come back to see some more fundamental moves in the market that make a little bit more sense, shall we say. But for the traders themselves, at the end of the day, with a market that is so strongly backwardated, it makes it very difficult for them to trade, because simply they are paying money away each time they put on a new trade. And to add to that, the uncertainties of the geopolitics, through the tariffs, through what's happening. So that was happening with China. We have the situation in Ukraine, which is extremely uncertain, and this puts the traders on edge. We don't know how that is going to evolve, which way it's going to go. So we follow the fundamentals, but we're always keeping an eye on what may happen that may trigger a different direction.
Well, let's take it step by step then, because we saw falling flat prices on one hand, and then we saw stubborn, like you're saying, backwardation on the other, except for fuel oil, which was the exception. How do you explain this disconnect, and what does it mean for how traders will be able to position themselves next year?
So my starting point is looking at the flat price. And when you look at the way the flat price is behaving over the last few months, has been quite correct according to fundamental economics. You can see the curve gently moving downwards as production has increased. But at the same time, you get this little clue from the structure of the market that there is some positivity in there. So we don't understand why we're seeing a falling market with backwardation in there. So it does put a little bit of worry in people's minds as maybe this isn't such an obvious trade to come down.
Okay, so like you said earlier, with everything that is happening in Ukraine and the Middle East, there is still a lot of uncertainty hanging over the near-term market. How sensitive is the current structure to any new disruption?
Well, it's going to be quite interesting, I think, because we've seen OPEC reducing their increase in production, but they're still increasing production. We see all these sanctions coming in to Russian companies now, but that oil has to find its way somewhere. And so then you see certain markets getting a bit more flooded. So we've seen that on the fuel oil market, like you mentioned, where the structure is completely the opposite. But the fear that the peace process doesn't go as planned, and in fact escalates in a different direction, puts people in worry. And if that situation happens, obviously we see a reverse of this trend. It's quite interesting, I think, that markets, generally speaking, over in history, have always sort of crept up gently, and there's been a crisis and they've dropped off. We seem to be having the opposite effect right now, with a gentle decline in the market with a potential to have a huge spike.
Okay. So given the market structure, the rate cuts, and all of the uncertainty you just mentioned, which, by the way, it makes me really nervous, even as I hear you say it, how should we view early 2026? Like, follow fundamentals or stay cautious?
I think you were always going to try and, in my mind, as a trader, you would always look to follow fundamentals because they generally make sense and have proven so historically. You just have to be careful. I think absolutely both. I think it's the unlikely event is likelier, if you see what I mean. And we can sort of cater for that in the way that we approach our hedging. it makes sense for people to follow fundamentals, and I think people really should be looking at it. But in the current scenario with the situations we have geopolitically, there could be a possible reversal of the trends, which could be very, very dangerous if you're too full in. There's an old saying we have in the market: never catch a falling knife.
Well, we'll have to keep an eye on everything else then. Thank you, Marco, for all your insight and for everything that you've given us over this past year.
Thank you.
And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.